I'd have to characterize the mood of cross-border international investors as somewhat pessimistic, or at least a little. I mean, another term would be freaked out, right? That there's a lot of things for people to worry about: geopolitical, political. Certainly, interest rates are not, diving back into the basement anytime soon. You've got valuations are down. You've got all sorts of issues that are out there, and there's just a real kind of uncertainty around the amount of change that's occurring. And a lot of investors are sitting there, really kind of, frozen in place and have been all year. There's been some more activity to the second half of 2024, and people are looking at 25, perhaps with some trepidation. And yet, even in that kind of environment, even in the environment where everyone is worried, there seems to be a tremendous amount of opportunity, but you've got to look at it with a different set of eyes.
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
And that's why I'm really excited to welcome Neville Rhone to the AFIRE podcast. He's the co-founder and managing partner of ARC Capital Partners. And I remember when Neville started this up, I guess it was a little more than 10 years ago, as he came out of Canyon and really had an interesting take on how he was going to approach it in an environment that was challenging. It seems like all you do, Neville, is find challenging environments and find the gold within them. So I thought it was very appropriate for us at this point, as we look at 2025, to welcome Neville Rhone's particular point of view to the AFIRE podcast. So thank you, Neville, for coming on board.
Well, thank you. I'm glad to be here.
Perhaps we'll just start with where you think there might be opportunity, where others are thinking, that's kind of weird. That's kind of hard. That's different. In particular, let's just start with attainable housing. Everyone talks about how difficult it is. Everyone talks about the need for more and more tax incentives. And I'm not saying the need is not there, but where are the opportunities that perhaps people aren't paying enough attention to in that area?
Well, it's a very good question, right? I mean, I think one thing that I think the entire investment community can appreciate is that there's still a significant disconnect in the supply of housing relative to the demand, right? Demand really high, and supply that actually works monetarily for those who are going to occupy really low ultimately. Right. And so, with that backdrop and interest rates have increased by 5% and now down, I guess, call it, 75 basis points, right? Recently,
right.
You have that, going on in the background. Plus, the reality too is that in some markets there has been a large, sort of supply shock again, right? In multi. And so for us, the way we approach where we seek opportunities is, really among those who are coming of age today that can only afford a certain amount of their pocket to go towards their apartment or housing, alternatives. And for us, the way we define attainable housing is that these are largely unsubsidized, right? Fully market rate. And then for an occupant who is going to look to spend a share, so 30% roughly of their income, based on 80% to 120% of the median income for an area, that's sort of how we think about how do you feel that you can price the rents for those apartments relative to the affordability for those who seek those apartments. Because what we found in our research is that largely, and I think it's going to be a controversial statement, but for those who are making much less, there are significant government subsidized programs in place to help at least start to support, that, sort of income, segment, right? For the lower income segment, subsidies, et cetera. Right. Then you have, call it the ultra luxury, AAA, amazing, high rise, beautiful buildings. Where, no matter how much you charge, it's only 10% of the income of that person because, right, that person has really, high wealth. And so there's that missing middle that we spend our time on. What's attainable to the largest, segment of the demographic out there that we spend our time on, and there are different ways we do that. And we can talk more about that, what we're excited about. But when you're approaching that space, when you don't have the subsidy, right?
Yeah.
And you're not chasing after a small piece of the pie in terms of volume of people, in terms of high income. How do you solve, right, being able to deliver at a basis that's attractive so that you can make a great return, at the rents you charge for that segment?
And it seems to me that missing middle, and people do chat about it a lot, and they talk about it being the area where the need is greatest,
Hmm.
and yet we treat them like the middle child. They really just seem to get the short end of the deal
That's right.
generally, and either they're paying too much based on their income, or they're going down market and pushing out those folks that really need the more affordable housing at the lower end just because it isn't there. That
Hmm.
being said, part of what that missing middle needs need to be proximate to services. They need to be proximate to jobs, just like everyone else. And yet, those desirable urban areas, I think, are in some ways the most difficult to make affordable just because the land values are so high. And yet, those seem to be the markets that you are operating in, is
Hmm.
that infill urban. How do you approach that and create a more attainable market rate housing?
Very carefully, ultimately. But I can tell you, part of what we do and what I think makes our team special, and I think something that we've connected on over the years is, you're looking to try to tie the history and the really kind of larger shifts happening, right, relative to the opportunity to see on the ground, right.
Hmm.
And I know you and I bonded years ago, about a decade ago, about Jane Jacobs, right,
Right.
and The Death and Life of Great American Cities, right? And even in that book, this is back in what year is this? Yeah, 50 years ago,
Yeah,
right?
easily.
The way that you can invest and create opportunities in these urban markets is oftentimes with existing physical plant in place,
Right.
right? So it's not about going in, tearing down, and going up, right? But can you take something, reposition it? By definition, you're at a lower basis.
Right.
Being at a lower basis, you can charge less rents to make it more attractive to a larger, set of people who want to be in those urban mixed-use walkable locations,
Right.
right? And so today, here is the interesting Venn diagram today, right? Today, like I mentioned, rate environment, we know the pressure on valuations, all those things. Today, there is actually a greater need for capital, right, for those who used to have many other alternatives,
Right.
right? Today, the ability to, candidly reflect the environment in the repricing of how you enter in these walkable urban communities is far different than it used to be, right?
Right.
And so, our latest investments that we've made locally here in Los Angeles hits that, with respect to the Venn diagram. We're working with a very large and established family office that owns millions of square feet of real estate in Los Angeles, particularly Koreatown.
Hmm.
That significant holdings, the majority is office, right?
Right. Right.
Okay, it was a great, amazing investment back when this was accumulated, 2 decades ago. Today, not so much,
Right.
right? Today, what do you do when you have, vacant office buildings that should be something else,
Right.
right? We need to go through, and I think in many different submarkets are going through this de-office trend
Right.
overall. But from our vantage point, we thought this was an exciting opportunity because you can take what is probably the wrong asset class, convert it to another asset class where there's more demand.
Hmm.
When you do that in the way that we've done it, is that we can then offer, great Class A apartments market rate at a significant discount to building this, brand new,
Hmm.
right?
Hmm.
And so what we are seeing in is that entire sort of the dislocation is playing out, right? The shift in what used to be a legacy business plan, right, now has to be truly legacy in the kind of the rearview mirror,
Right.
right? Going forward,
Right.
what do you do? And then so from our vantage point, our philosophy has always been from day one has been, we all have different stories, right? Our name ARC comes from the arc of a story and the
Right.
narrative, right,
Right.
of every capital stack, of every location, every neighborhood. And with this particular partner we have, we were able to basically restructure, take that property, that office building, put it into a new joint venture, come in with new capital. And then, when we're all said and done, and by the way, actually, I'm going to detour for a second. This particular owner and investor has done residential conversions from office 9 times, 9 other times.
Excellent.
Right.
Excellent.
So this was not a speculative, hey, let's see what we can do, but it was like, okay, amazing track record, great relationship. We know this neighborhood very well. We're practically neighbors from other holdings we have.
Right.
And so we, came in with a different way of saying, well, we all have a puzzle to solve, right? We know the story, and 2, 3, 4, 5 years ago, one could, keep the blinders on and say, hey, I don't need more capital, or, I don't need to convert because things will work out. I can get a refinancing. I could sell to somebody else. That's not happening today.
No,
it's not happening today. Right. So how do we solve?
There's a through line, I think, here to what you're describing that I'm hearing a lot more of, which is all of these things are really, really hard. So the world is saying right now, forget about conversion to office to residential because it's too expensive. It's too difficult. The engineering challenges are horrific. It just won't work, except in very few exceptions. And that's kind of the conventional wisdom right now. And that may actually be true, but at the same time, it does not get rid of the possibility and the opportunity that is there. It's just really, really hard. You have to be thoughtful about it. And certainly the conventional wisdom is that the capital stack is broken, interest rates are too high, there's not enough debt availability, so nothing can happen. Well, it is possible. It's just hard. It's going to take some time. It's going to take some thoughtfulness as we do this. And it's not going to look like it did before. And I think that's one of the biggest obstacles. It doesn't look like what has been successful elsewhere, which when you and I first met, it was in great part because I had sat through and I think Magic Johnson spoke to everybody in the real estate sector. He's such a wonderful, charismatic speaker. But, telling the story of basically discovering incredible economic activity in urban neighborhoods that no one really paid much attention to, that Starbucks did not pay attention to. And at Canyon, to a great extent, I think some of the success came from that kind of thinking, that kind of, well, this doesn't look the same. And here you are taking office in Koreatown and realizing, oh, wait a minute, this is an opportunity. How do you encourage that kind of thinking in your own work? And in the work of your colleagues at ARC, how do you hold on to that kind of, well, we know this is different, this is a little harder, this is a little weird, but let's keep looking?
That's a good question. I mean, I think, there's that term, I think, what is it? Your culture eats strategy for lunch, right? And our culture, I mean, I think part of our special sauce is that we do think that difference, coming from different backgrounds, having different education, bases, cultures, everything, that brings to the table the ability to think about risk differently, right? And protect it, not to take it on, by the way,
right?
To mitigate it, right? To reduce it, not to make it more, right?
We're in the risk business, absolutely.
Exactly. Yeah, right. But then also opportunity, right? And so the undercurrent of our culture is, in addition to working really hard, in addition to being okay with complexity, in addition to hopefully being efficient as a team and nimble, all those things as an entrepreneur, but having high institutional standards, we appreciate the fact that we all have different ideas about how to create value, right, and how to mitigate issues that in any particular investment. Right? And so whether you are a co-founder or the the analyst on our team, we do look to sort of call it encourage bringing to the table the best of your ideas.
Right.
And I tell you, everything is changing so much right now, right? And I give great credit to prior generations, not mine only, right? But prior generations, today's generation, and the future generations, right? For saying, okay, well, we need to just think about what we have in front of us differently going forward. And so that's always an undercurrent, right? We come from different backgrounds.
Right.
We come from really, our own stories about how to impact the communities where we invest. And when you layer upon that we're able to be flexible in how we attach to these opportunities in, really equity, preferred equity, JV, et
Right.
cetera. That's something else that we have given most of us has spent time either at, development or finance, private equity, otherwise. So the toolkit is also larger, and we just make sure we can really touch upon all of them. So it's a cultural, embracement, right? We
Yeah.
embracing, I guess, of how do we look forward around these issues that we're facing in front of us these days.
That culture and that that approach, if you will, is something that we often associate with more entrepreneurial shops. We think of that as perhaps being on the fringe to a certain extent, and yet ARC has managed to attract significant institutional mainstream capital in your vision. That is the fuel that you are putting to work is coming from more conventional capital.
Hmm.
How do you help them understand why this sort of approach is a wise, risk-adjusted approach? And certainly you've delivered over the last decade in terms of returns.
Hmm.
This is not a charity. This is, continues to be double-digit return territory in this space. How do you communicate that, or how do you help your investors understand that this is a way of thinking that is more future-proofed, perhaps, than looking backwards?
It's a good question. Very good question. I mean, I think ultimately, if I'm going to be candid in my honesty and how to, convey this, and it's really about the stories,
Yeah.
and it's really, that's, I would say, is call it the challenge of what we do,
Right.
because everything that we do, it's in the middle market, right? So Blackstone is not paying attention. Brookfield is not paying attention to it, right? It's too complicated for the smaller investors, right? So they're not paying attention to it,
Right.
right? But when we tell the story to a large pension plan that's saying, okay, two things. First is most transactions in real estate are actually middle market in size,
Right.
right? 90% of trades are in that window of $10 million up to $150 million in size.
So again, the middle child. That's where the opportunity is, the middle child, however you look at
Exactly.
it. Yeah.
Exactly. And then, when you have a situation where the middle market is fragmented, there's dislocation going on across the board, right? We are saying, hey, look, given our skill sets that are quite diverse, we're going to come to you as a sponsor or you as a neighborhood city council person, whatever the case may be, and have a solution that matches to that. It's a story, right? And so
Right.
the way that we get most resonance is we talk about taking that office building, putting into a joint venture, restructuring it, bringing capital so we can make apartments that are very, very attainable, right? For a 97 walk score location. We talk about that.
Right.
We talk about going to a place, mixed use property, that's a beautiful, amazing mixed use property that had a loan that was probably 30%, underwater,
Right.
right? We
Right.
looked at refinancing. So what do you do, right?
Mm-hmm.
We come in and then help solve that gap.
Mm-hmm.
I would say it's differentiated, and those who seek, we want to access the middle market. We want to have those who have, both the grit, and the creativity to be innovative, in the solutions for these markets.
Right.
But still major tailwinds around where people are moving,
Right.
and how they're composed, right? What they're looking for, having that tailwind behind you. Those are some of the things that gets investors excited about us.
Yeah.
But I tell you, if we were whatever, a data center, fund would be different, right? I love data centers, but
Yep.
it's a very kind of specialized, I would say, avenue that we provide to large investors versus more sector specific, and that's different. We're diversified, and that's no question different, but resonates with those who we've been very, very fortunate to partner with in our funds.
Well, absolutely, and I think it's kind of interesting that you're not just investing in housing. You're investing in some level of retail. You're investing in some industrial. It all seems to be supporting this kind of understanding of a community. And we've been talking about Koreatown. Obviously, you're in a lot of markets in the Sun Belt, but you know that area. That's where you're investing. And I love the way that your group talks a lot about the changing demographic picture. And we all, in real estate, we love talking demographics, but your emphasis seems to be a little bit different in terms of talking about, and not from a standpoint of doing it for any kind of regulatory program or what's the right thing to do, but looking at the changing demographics in terms of diversity, in terms of, multicultural, that it doesn't look like 1955 in terms of the demographics. And that changes the demand characteristics. That changes where people want to live. It changes how they're living, how they're working, and all those pieces. It seems to me very different from the kind of top-down kind of pension plan going, well, we want to have a certain amount of our investing is labeled as DEI, or it's labeled as sustainable. Everything that you're talking about, and yes, you do a lot of sustainability, and yes, you're dealing with this, seems to be driven around the evolving market, not looking at it as good, bad, whatever, but saying this is where people are. Here's your forgotten middle child. Here's what's happening there, and then investing accordingly. And so you're getting it sounds like you're getting a positive, well, certainly the proof is in the pudding, the funding that's coming in. How do you think your investors are kind of thinking about investing in ARC and investing in those kinds of programs, how that fits in with their programmatic approach around some of these things?
Yeah, good question. I mean, I thank you for acknowledging that too, because we are 120% focused on getting the best risk-adjusted returns we can, right? As a partner advisor, of these LPs that we have, right?
Right.
That's always the governor. First and foremost. And then, the other thing, though, that we all do in our businesses is that we try to understand where the puck is going, right? What's changing to habits? How are decisions being made differently, or how they're tilted overall? What does it mean to be digitally? Actually, it's not digitally native anymore. We're going to have a whole generation of kids who are AI native.
Right.
What does that even mean? I don't know yet. But, what we're looking to do, right, is, and I think it's a complex, Venn diagram again, in sense of we're conveying a thesis which is very core to who we are as a team, right? We view generally multicultural demand as being a feature and not a bug, right, of opportunities where we're spending our time. Right. It is not political, right? It's alpha generation. That's what it is, right? And so there is still, it's hard, and it's also hard to ignore the numbers, right? I mean, you have, 95 million people who are here, second, third generation, right? Who would, I would love to go as a, whatever, with my background, to go to a Latino-owned grocery store, right? Where the programming there and the offerings are fresh, great, and cook more. I want that as an option. And I have a lot of money, right? And I just got my degree, became a doctor, or I'm working in finance or media, whatever, right? And so it's really about how are you focusing on chasing the buying power of a generation that's coming of age with, more dry powder overall. I mean, again, there's no question that people are stretched because of recent inflation, et cetera, but, far better today than, back in 1955. And that whole, the whole shift is pretty dramatic. So when we hone in on, hey, we're taking a view that this is driven by the best risk-adjusted returns that we can achieve, sometimes it overlaps with, the programs that different places have. Right. But we're not as focused on that. We're really focused on, hey, we're a great investor. We are really giving you access to the middle market. We're going to be, hopefully great long-term partners together. And by us doing things in a manner that is respecting those who are coming of age today, you could actually generate great returns. That's sort of the overall thinking. don't have to match altogether.
Absolutely. Why do you do this? You do this because you make money at it. And I think I love what you said in terms of not political.
Hmm.
And that's especially difficult, I think, in the current environment, because to a certain extent, politics and geopolitics probably matter more in terms of the outcomes for real estate investors than it has at any point in our careers. That this stuff is having an impact. The question is how much of it.
Hmm.
But to be in that environment, to be more aware of it, perhaps, or to take that into account as part of your risk return profile in terms of what's happening politically, but at the same time to not be political, that's hard. I think that is challenging. We're all human beings. We all have our own fears and opinions and wishes and whatever else it might be. But to somehow thread that needle and be non-political, to accept things as you find them,
Hmm.
and to proceed accordingly, while realizing that there are political forces that are also driving some of the outcomes as well, and understand what those are and to be able to play with them. I think it's one of those things that can help us move forward from some of the noise that has emerged around things like DEI, which at the end of the day, it's just acknowledging this is a multicultural kind of environment. There's a lot of different people that have wonderful things to offer, both economic as well as cultural. Let's embrace that and work with that.
Hmm.
And it also, I think, extends to sustainability. And when you think about how there's more and more of a divide between how Europe and Canada approach ESG and
Hmm.
how in the US we are approaching it. And part of it's just political and rhetoric and how you think about regulatory, carrots versus sticks, et cetera. But you have been a leader as well on sustainability, on governance, on social aspects. But I don't get a sense from you that you're doing this to check some boxes, or maybe I'm not seeing what the boxes are. So why do you even care about sustainability? You're solving all sorts of other problems. Why do you think it makes sense?
Because it's something that our tenants, right, want. Because it's a desire of those who are going to be paying rent to you,
Yeah.
right?
Yeah.
And when we talk with folks on the ground, to a T, 99% of them love the fact that we encourage repositioning and redevelopment of properties versus tearing them down. Love it, right?
Yeah.
The when we look at and think about the way that we go about, our business, the whether it be conversions, like we talked about, or taking what we've seen and putting capital in to call it re-enhance and redevelop and reimagine.
Right.
It's really what the tenants are looking for,
Yeah.
right? And so starts with the demand, right? And keep me off Twitter, but I mean, I do believe it's the right thing to do.
Right.
I mean, that's a personal thing. I mean, that's just, and I do believe that, the less you can do in terms of, sort of carbon in the atmosphere, the less you can do in terms of, creating waste, the less you can do in terms of tearing things down, the better it is, just sort of long term as a father, right?
Yeah. Yeah.
Um, but certainly if I thought that we were providing product that didn't meet the demand of what's been requested of us from our tenants or our partners or otherwise, we wouldn't do it.
Yeah. Yeah. Well, I do think that's an important mental shift that not everyone has taken yet, but I think people are getting there, which is less, sustainability is an added cost,
Hmm.
to, actually it's not really, and it's a great opportunity, and it's certainly
Hmm.
what the market is asking us to do.
Hmm.
That it just makes sense for us to proceed that way. I think that's a healthy transition. I think it's one that we all have to make in terms
Hmm.
of understanding. Yeah, we may want it personally, but that doesn't necessarily mean that that's going to be an unreasonable cost, or it will add unreasonable risk to the game. And again, you're still delivering meaningful returns and enviable returns from
Hmm.
that approach. That it's really it's proven itself out over the last couple of decades as being a wise, prudent strategy, not just for the world, and that's one thing. But we can put that aside and just be evil capitalist. But because this is a great way to create that consistent risk-adjusted return that we're all looking for.
Absolutely.
So what do you think, I'll leave it with just one last kind of thought. What is it you think most people are missing? If you could just, get out the megaphone and get everyone to understand, what are the things that either a risk or an opportunity in 2025 that you would like to see people pay more attention to?
That's a good question. I think that, wow, I'm actually almost stumped on that one, to be honest. Because, in reality, right, what we do as a team is that we look to uncover opportunities where others don't see them. Right. I mean, that's just we live, that's our happy place. That's our happy place. Right. So I'm conflicted because I don't want to share anything that we see that others don't. I don't want to have one to come,
Fair enough. No, but I think that's actually, that's an important thing for us all to keep in mind. Everyone to keep in mind. At the end of the day, probably the most risky strategy is to try to be looking where everyone else is looking, and to approach things the way everyone else is approaching them. Yes, it gives us a sense of security, but it may be a false sense of security to do that, as opposed to truly being differentiated.
Mm-hmm.
I love how when I ask companies to tell me what their differentiators are, they tell me all the things that make them exactly the same as everyone else, with one caveat, which is also the same as everyone else, which is, and we try harder. And I'm like, that's not a differentiator. That's you trying to be one of the cool kids, when actually the strategy is to be true to what is different about you, to be true about, where you're going. Well, Neville, this has been a fantastic conversation. We've kind of gotten to the end of our time here. We've been speaking with Neville Rhone, who's the co-founder and managing partner of ARC Capital Partners. I would encourage anyone that's listening or watching this to maybe take a little bit of time to check out what Neville and his associates have been doing over the last decade at ARC, and to understand the arc of their story. So thank you, Neville, for joining me on the AFIRE podcast.
Thank you. This was a fantastic conversation. Thank you for taking the time. This was awesome.
My pleasure.
You have been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.